A lot of mixed signals, not mixed signals, a lot of conflicting signals on the JPM trade. I dug a little deeper into the exchange tagging.
It's 60.55, right?
It is not 60.55. It is 63.60 is going to be the short strike. Here, let me grab this. I'll throw this in voice chat so you guys can see it.
There's something at 60.55 though in there.
Yeah, that's this. Yeah, that's December. That's the big one.
Okay.
You can see it right there. 60.55 is the big one. So we won't process this change in OI until in the morning. So if you go looking at like 63.60 right now, it won't look like it's short. So just letting everyone know. Well, that won't take effect until early tomorrow morning. But yeah, if you take a look at here while you're queuing that up, I'll share my screen here so you can see it.
Oh, you're talking about the smaller structure is a 63.60.
Yeah, this is the one
Got
that
it.
just fired in November, right? This is Fridays right here, the 63.60 with 50/50 contracts. So it's actually smaller. It was slightly larger. And what so the assets under management, AUM, has decreased just slightly for this fund. And just to get everybody on the same page, they have 3 funds and they are a month apart, right? So when we take a look at something like this, you're looking at, so here's Papa Bear, Mama Bear, and Baby Bear, right? And that's those 3 funds. And this is the smallest. And why this is, 5,000 contracts isn't necessarily a big number. It's, in our context here of how we do it, it's there, right? It's meaningful, but it's obviously a lot smaller than it's a lot smaller than what we have over here on the Papa Bear there. So sorry about that music starting up there. I don't know why Spotify triggers, but anyways, so yeah, so 63.60 upper strike, 57.10, and then 48.20. So you can, this is 5% below where we are right now. So you can see that we got some dropping to do for this to at expiry to be worth something. But on the interim, as we drop, it'll start gaining some speed. So I'm thinking of actually putting something like this on just as a basic hedge. I don't know if I'll put these strikes on Monday, but I'm looking to protect a couple 100,000. Each one of these contract structures that you put on, if you put it on just like JPM in the terminal P&L, you get about $70,000 to $80,000 of downside protection, down to 20%. So each one of these contracts is pretty powerful, and you can protect a portfolio. I've got a large amount of cash raised right now, so if I look to deploy cash into if we get a rally, I'm not sure we're going to get one, but if we do get a rally, then I'll be looking to maybe put something like this on just as a downside hedge, a 0-cost downside hedge. So we'll see. Anyways, didn't want to take away here, so I'll quit this.
And for the newbie, Paul, those strikes are mechanical, right? There's not really discretion.
Absolutely mechanical. There's no discretion in here. In fact, it looks like this, just so people understand. Yeah, for the newbie. So what happens is JPM, you have spot price that's sitting right here where the cursor is, right? And the first thing they do is they look 5% down. This is all mechanical. This is all in their prospectus, right? This is no interpretation except, reading. 5%, they go long. So it's a long put. Then they go down 20% below this. So this is 15 here and 5 here below spot. And that's what that number 2 is. And then this here forms a long put spread. And the way this makes money is if price moves towards that direction, I'll show another graph here momentarily. You'll start making money. But this has a cost, right? Put spreads, debit spreads, they have a cost. And so what they end up doing is they end up collaring it with a short call. And what they do is then they go out, and this the reason this says 3 to 5%, and it might be 3.5 to, we've seen them do as high as 6%. It just depends on the volatility and how much premium they're getting. But in general, the prospectus calls out that they go out to where the circle 3 is, and they sell a call to pay for the debit and all their expenses. And they do that in this particular case. They did it about 11:17. It's a shortened day on Friday. So they did this about 11:17 in the morning. And then after the close at about 1:07 Eastern time, they adjusted it. And so these numbers that I'm showing here are the adjusted numbers. These are the final numbers. I have a 99.9% confidence, and I presented the information in the JPM channel, in the JPM Hedge channel, why that is. But the bottom line is, these are breaks are. And so basically, you're exposed to the market here. You're effectively not exposed to the market here. And what I mean by that, so think if you have, so notionally, let's go back to this real quick. Notionally, this level, if this is the 0 line right here, this number up here for one contract set, right? So 3 contracts. You got this put spread here, and then you got a collar here to pay for it. This level up here is roughly $70,000 to $80,000. So if the market were to collapse greater than 20%, you're basically exposed to the market again. And I'll show you what that means here, but you effectively have $80,000 protection. So barring any, unforeseen event in the markets, you're not going to have to worry about it, right? So most of the declines that occur in the market over a 3-month period don't exceed 20%. I could spend time talking about it. I've analyzed this in some detail. Why did they pick 20%? And it's because 18% of the time is pretty safe for a 3-month period. And these are 3-month blocks of whatever. So $80,000 protection. And the way it works is you're long the portfolio. You're long the S&P 500. And when you're long the portfolio, you're exposed in this area. So if it goes up 3.5 to 5% or whatever the number is, you'll make money. It's like a covered call, right? This is effectively a covered call. So you're exposed to the market here, and then above that, the covered call, which is the short strike, would start to lose money. But because you're long, you're flat. So if you're long 1-to-1, right, you basically are walking up the curve. Then when you hit that short strike, as you go above it, your portfolio is long. And as long as you're balanced between that and that SPX call, you're basically flat, right? So when you get to expiry, you'll have to liquidate something. You'll have to, because of the cash settled, you're going to have to do something here, because obviously if this is just the SPX and you're up here, you're losing money, right? So at the end of the day, you're going to have a debit from your account. In order to offset that debit, you're going to need to sell some stock to break even, or you just take the loss and say, I gained it one way, but I took a hit the other way. Either way, cash settled account, it's flat. This is a brainless mechanical strategy that JPM implements. And for anyone who thinks it doesn't make money, you are solely mistaken. I don't know if I've got the numbers here. Yeah, this is old. Let me see if I can call this up here real quick. This thing actually makes money, and they've been doing extremely well. So if you want downside hedging availability, this is a brainless way to do it. They've upped their requirements. I think you need $1 million now to actually do this. Let me just grab this link here real quick and see if it comes up here. Yeah, they're up 20.33% year to date. Here, let me show you. Yeah, 20.33%. So, you know, I know the S&P 500 is up. No question. The Qs, they're up, right? They're up over 20 to 30%, depending on which one you look at. But here's the deal, right? And you know, anyone who criticizes this probably doesn't really understand this. You have virtually no risk for 15% of the portfolio. You've just taken out a whole bunch of downside. So if the market falls 5%, then once the market, you know, starts really collapsing, your portfolio is effectively going to be flat in its overall response because you're long the portfolio. And here's where we have a degree of freedom that others don't. You don't have to invest in JPM to do this. You can do this yourself. That's why we publish the strikes. As the market starts to collapse, you actually are going to start walking up. So here would be like Friday's situation. These strike numbers don't apply here, but you get the idea. So we're right here as of today, right? It's effectively Friday. If the market were to collapse starting Monday, you'd be walking up these interim P&L curves, and you can see you're moving up quite a bit here. You know, $5,000, $10,000, $15,000 as you start walking up. Each one of these blocks is about $5,000. So if the market does start to collapse because of extrinsic value, not intrinsic on the put strike, but extrinsic value, time value, you actually will start to gain some money, and you can lighten up on your long portfolio, right? So now you're imbalanced, and that can be a good thing too, because now your downside, instead of being flat, like I described here, you're now actually going to start participating on that downside. They can't do that. JPM must stay invested for the 90-day period. So we have a degree of freedom as individual investors and traders that JPM doesn't have because, you know, they're regulated by the SEC and whatnot. So we can learn a lot from them. You don't have to do this, of course. Nobody has to do this. But you can learn a lot from how the big boys and girls are doing it, and it works. It works pretty damn well. There's always a yeah, but somebody's always going to say some uninformed argument. And at the end of the day, I challenge anyone to come up with a hedging strategy that equals or outperforms the market as consistently as this does. So I'll leave it at that.